Geetika Shrivastava, Executive Partner with Tattvam. Can we have Geetika with big round of applause, please?
Thank you so much, UBS Forum, for having me here. And very good morning to all the people who are present in this seminar. A quick introduction after what Sir has already said. I'm an executive partner with Tattvam Advisors, and we are a team of almost 175 members, primarily assisting our clients all across India in the area of GST advisory and litigation support. With this, I'll just quickly start my presentation. So, in my presentation, I am going to focus mainly on 4 practical issues where a lot of interpretational scopes are there, and what we are dealing day in, day out with our clients when we are handling their litigation. So, to begin with, these are the 4 issues that I'll touch upon, very specific ones, maybe affecting most of the people who are in this forum. So, the first one I'll start with is the ITC eligibility of tax paid under section 74. Now, why does this question come? The question is coming with respect to any tax which is paid under section 74 is because these days we are seeing that the department is very active in terms of investigation. Lot of inquiry, investigation, teams are sitting, coming over the office premises and asking for a lot of issues. And then there are certain legal development which are also happening. So, for example, recently there is this tax which has been decided that there should be a tax on secondment of employees which we are taking from our foreign entities. Taxability of corporate guarantee, what should be the valuation, so and so forth. So many classification disputes which keep on coming, whether the product is taxable at 18% or 28%. We must have charged 18%, department is alleging 28%, and therefore somewhere down the line these are the issues which were, they have developed over a period of time. When the GST came, it's almost 7.5 years that people have now started settling with certain legal positions. Now the issue that comes over here is that when during an investigation any tax is to be paid, so can my recipient take the credit of that tax? Or say for example, when I am talking about the secondment of employee, when I have taken it from my foreign company and then I have to pay tax on that and RCM. So today when I am paying RCM, can I take credit of that RCM that I am paying under for this particular supply, and which is being paid during the investigation and inquiry? So if you read the provision of the law, section 17(5)(i), it restricts the credit when it is paid in terms of section 74. But it does not end over here. You also read rule 36(3), which says that that ITC is restricted only when the tax is paid in pursuance of any order issued under 74. So the dispute or the argument which keeps on, the contention keeps on coming is the department says that while I started the investigation and inquiry, I will issue a show cause notice, or even if any investigation, I will treat it as a 74 case, it's a fraud case, etc. And therefore, wherever, if I am a recipient, my supplier is issuing me any debit note, or if I talk about a reverse charge case, they dispute that this credit should not be eligible because it is specifically restricted under 17(5). So our argument to that is that when you read 17(5) read with rule 36(3), it does not say that any proceedings initiated under 74. It simply says you cannot take the credit when any order has been confirmed. So our take on this is that in case no order has been issued, till the time show cause has been issued, and even after issuance of show cause the taxes has been paid, an SSC has a very good case to argue to say that there cannot be a denial of ITC under 17(5) because the order has still not been issued. Law is very specific to that extent that only when an order has been issued, then only the ITC should be denied. So this is something which, if during the course of investigation any tax is paid by us or by a supplier, and the suppliers are issues any debit note or tax invoice through that extent, in our view, a very good case to argue for a recipient to take the credit, and this is at a higher forum a very good chance to have a favorable decision from the courts. Now what happens that if any tax is paid after issuance of order? There could be a situation where you could not make up your mind, or you could not decide whether you have to pay before the order and the order has been issued. There also we see an opportunity that if we can challenge the eligibility of section 74 notice itself, that 74 notice has to be issued when there is any intention to evade tax by way of suppression of facts or omission of any statements or any fraud that you are doing. Wherever there are issues relating to classification, interpretation like secondment of employees and the corporate guarantees issues and all, very strong case to say that it was never an intention to evade the tax, it was an interpretation issue which was going on in the industry. And now because the department has taken a decision or any judgment has come which is deciding that this particular transaction should be taxable, should not be treated as a case which is falling under 74. Therefore, even if the tax is paid after issuance of order, this order itself can be challenged, that 74 proceedings should not have been initiated and the credit can be taken by the recipient. So, this is something very day in day out we are dealing after these lot of developments which are happening, and classification is a very common issue which keeps on coming. So, a very strong case where people want to take credit and these types of scenarios are coming. Definitely you can look for an opportunity for claiming the credits over here. One question normally comes up that whether this particular restriction is applying also when I am paying any taxes under customs in terms of imports. So, again if we read section 17(5), it only talks about the payments or the taxes which are paid in pursuance of order under section 74 of the CGST Act. It nowhere links it to the Customs Act. So, there we can always say that this particular section will not be applicable when I am taking any credit in respect of any IGST that I am paying on any imports which are being done by me. So, here again if any such remand is being raised, it is a good point of contention that can be made and the ITC cannot be denied. Very recent decision of Safari Retreat and the consequences that we all have seen. We all know when a court's decision is not in the favor of the department, then the legislature can always come and make the retrospective amendments. I will not get into the details of what was discussed in Safari Retreat judgment, just a glimpse of it, that what Supreme Court held in this judgment was that the expression which is being used under section 17(5)(d), that is plant or machinery, is different from plant and machinery which was used under 17(5)(c), and therefore there is a scope of argument that any building or any equipment which is qualifying as a plant, and a plant not as defined in the law in common parlance test and can satisfy various functionality tests. For example, if it is a very specific building which is used for a particular reason, a storage setup which is particularly made up for a particular type of warehousing or a storage activity. So, therein they said that if these tests can be proved, there is still a scope of argument for the assessees to say that the credit which has been denied under 17(5)(d) with respect of goods and service used for construction of any plant or machinery, this should not be denied, and the court left it over there for lower courts to decide in each and every case that whether any particular equipment, building, plant is qualifying for this definition and the test, it's holding good in the test, and therefore the credit can be looked upon that it should not be denied. But alas, we have legislature which comes in front. The GST Council in 55th Council meeting, they decided that they will make the retrospective amendment in the law. It was just a drafting error which was also argued in the Supreme Court judgment, and they said that this has to be read as plant and machinery, and retrospectively with specific explanation being added in the law that this will all nullify any decision of the courts or any circulars or clarification whatever has been given by the department. Now, after this decision, what's the word around in the fraternity is that will this credit be denied, will the Supreme Court judgment be completely nullified, can I not take any other benefit because now they have amended the definition. Here I will just take you to a very specific para 32 of the Supreme Court judgment. While it is not forming part of the conclusion of the decision, but during the discussion they have actually discussed two parts to it. that when a credit has to be denied, then there has to be two twin test theory kind of a thing they have described, that one, it should be qualifying as plant or machinery, and it should not be used on his own account. So, only in these two cases the credit will not be denied, otherwise the credit will be denied. Now, here I will leave a food for thought for all the audience over here, that despite of the fact that during the verdict, in the conclusion, this part has not been very specifically mentioned, can it still be argued that even if the definition the plant or machinery has been replaced with plant and machinery in section 17(5), since there is another test that has to be qualified, that if it is not on his own account, there also the court has discussed that when you say that it is not on your own account, when they said that when it is on your own account, when you are using it for your own consumption, and when you are making and giving it out to someone else, then it can be said that it is not on your own account. So, can I now say that even after the amendment, there is a room to argue that in case any construction is being done, any construction activity is done, the goods and services are being procured, and it is not for the own usage by the person who is procuring these goods and services, it can still be, can it be said that the other part of the exclusion or the restriction in the 17(5) has not been satisfied, therefore, this particular restriction should not apply. And if I am, let us say procuring goods and services for construction of a building which is rented out or leased out, then the credit can still be availed. I am not concluding it. I believe this is one scope of argument which can be taken by anyone, and of course, the courts it has to be decided by the courts. I am no one here to take a decision on this. But I believe that this is something which can still be taken to the courts to say that even if it is not satisfying the plant and machinery definition, since it is not on own account, the usage is for someone else, the credit benefit should not be denied. I will leave it over here because this is something which will be taken up at the court of law and can be discussed, and a decision can be taken in a different way. Now, when we talk about the related party transactions, there are a lot of transactions, but my specific focus today is on the corporate guarantee. Corporate guarantee again has been in discussion for quite a long, whether it should be taxable, not taxable, many people were paying, many people were not paying, and finally there have been a lot of circulars and clarifications from the department that okay, if the corporate guarantee is given between the related party, it has to be, the GST has to be paid even if it is without consideration. So, this discussion we will divide into two parts: before 26th October 2023 and after 26th October 2023. The relevance is there is some change that happened in the law. Now, prior to 26th October 2023, law was, as it was worded, was very simple, that in case you are providing any services to your related party, and in case you are able to take full input tax credit, rule 28 second proviso, then whatever value has been declared should be considered as the value for the GST, and therefore, no one will come and talk about the valuation principle, etc. So, even if it is X value, Y value, they were not challenging. Now, of course, there were a lot of disputes whether nil value can be taken or zero value or no invoicing, so on and so forth. So, there have been multiple line of clarifications and circular from the department wherein they have clarified that even if it is a nil value and you are entitled to take full credit, no issue, there is no challenge for GST demands, etc. Even if you, let us say, you did not even issue any invoice, because obviously people did not know whether they have to pay or not, so the invoicing, etc. also did not happen. So, while even the law was saying that there has to be a value, etc., even if it was no invoicing scenario, the circulars they allowed that you can, there is no need to pay taxes if the recipient is entitled to take full credit. So, these were the clarifications which were given by the department prior to, which were applicable prior to 26th October 2023. What happens that when the recipient is not able to take the full value. Is it an open and shut case for all the taxpayers, or can still there be an argument? Yes, of course, in case wherever there is there is a situation where there is no full credit allowed, then we can argue that this particular transaction per se does not qualify as a supply, and only judgment that as on date we have in hand is of an income tax which says that these are shareholder activities, therefore no one should be taxed on a transaction like this. Post 26th October, there was a change in provision where they specifically formed that wherever you are making any transaction with the, you are giving any corporate guarantee to any of your related person, and it is given to any banking companies or financial institution, then 1% value of the guarantee amount has to be considered as a value. Whether or not you decide you have paid or not, if it's a no consideration situation, deemed valuation has been given in the law. And again the full ITC benefit they have given. If it's a full ITC situation, no need to pay taxes. Now here, wherever again full ITC is there, we don't have any challenge. Issue obviously will come when there are transactions where there is no full ITC available to recipient. There also there can be various issues which are like whether it is being given to any NBFC, because these days guarantees are also given to AIFs and all who are not qualifying as NBFCs. So probably you will have to look at that. Can I take this argument that if it is not given, the guarantee is not given to any banking or an NBFC, then this provision will not apply. Then there are certain clarifications also around that, whether it's a one-time supply or a continuous supply. According to us, the law says that it has to be paid 1% per annum, so it has to be treated as a supply which is renewing every year. In one of the clarifications, they said that if you are giving a guarantee for a complete 5 years, then you pay 1% on that guarantee into 5 times the 5 years ka period and pay upfront. Our view is different to that, that if law when it talks about that it has to be seen on annual basis, no need to pay, because in between someone may pay off the guarantee amount also. So why should I pay something at the advanced stage for a future period which I may not continue for the entire 5 years time. So these are few things that has to be seen while there are clarifications, and of course at the end the argument which can always sail through is that this particular corporate guarantee supply itself is not a transaction is not a supply per se, and hence therefore this entire rules and everything can be cannot be enforced on any taxpayer. And the last part is very small amendment which came last year in refund rules. Rule 9610 has been deleted. A glimpse of this rule, there were certain restrictions to the people who were importing goods under advance authorization schemes or EPCG schemes, or they were taking goods from any merchant exporter. They could not have exported with the payment of GST, because there was an idea that people would liquidate their accumulated credit, because major part of imports have been duty free. Now this rule has been deleted, which means that now the taxpayers can still explore, even if they are following all these schemes, they are getting beneficial import schemes, they can still go for a export with tax position and can always see whatever accumulated credits are there, and you can use them to pay off your export GST transactions and go for a refund of this. So this is something which business can look into from their perspective, and you can explore all the refund opportunities in this. With this I would end my presentation. Any specific questions if any would want to ask?
Thank you for your time and presentation.